Identifying key market structures and liquidity zones is one of the most important skills in smart money trading, because before price makes a major move, it often targets the areas where stop losses, pending orders, and trapped traders are positioned. In this video, we will break down how to identify swing highs, swing lows, equal highs, equal lows, turning points, and daily highs and lows as liquidity zones on the chart. By the end, you will understand how these structures influence price movement, how liquidity sweeps create trading opportunities, and how to use these levels to build more precise trade setups. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. Let's begin. Liquidity levels are areas on the chart where a large concentration of orders, such as stop losses or pending orders, is likely to exist. These areas can act like magnets, pulling price toward them before a major move develops. Imagine this is our recent price action. We know that if price pulls back into this level, many price action traders may look to go long and place their stop losses below that area, trying to protect their trades while benefiting from the bullish move. If price continues moving higher and approaches the swing high, traders may mark that area as a target, take profits there, or even look for short positions near the resistance zone. Because of this, liquidity builds below swing lows and above swing highs. These are commonly referred to as sell-side liquidity and buy-side liquidity. So, liquidity above a high or above a group of highs represents buy-side liquidity. When price approaches this level, bearish traders may enter short positions, or they may protect short positions they already opened. On the other side, breakout traders may enter long positions if price breaks through that level. The sudden move created to take this liquidity is called buy-side delivery. Price runs higher to engage the liquidity resting above those equal highs. In this situation, algorithmic price delivery can trap traders on both sides by engaging liquidity before smart money takes control and drives price lower. In the same way, liquidity below a low or below a group of lows represents sell-side liquidity. Just like in the bullish example, when price gets close to this level, bullish traders may look to go long, or they may protect long positions they already opened. On the other hand, breakout traders may enter short positions if price breaks below this level. The sudden movement designed to take this liquidity is called sell-side delivery. In this case, algorithmic price delivery traps traders on both sides by engaging the liquidity below the lows. After that, smart money will often move price higher to target buy-side liquidity. One important detail to understand is that the market often moves away from levels where liquidity has already been swept. At the same time, price tends to move toward levels where liquidity still remains. Imagine this line chart as a simplified view of market movement. When market sentiment is bullish, sell-side liquidity becomes more important than buy-side liquidity. This is because sweeping liquidity below these lows can often signal a possible bullish continuation, creating an opportunity to go long in the same direction as the dominant trend. Now, let's talk about the key types of liquidity you should learn to mark on the chart. Number 1. Swing highs and swing lows. We have mentioned these terms many times, but what do they actually mean? Swings are price turning points where 3 candles form a specific price pattern. A swing high is a candle that creates a high, while the candles before and after it have lower highs and lower lows than the middle candle. Similarly, a swing low is a candle that creates a low, while the candles before and after it have higher lows and higher highs than the middle candle. This pattern is confirmed only when the third candle closes. In this example, these are the swing highs and swing lows that we can clearly identify. Keep in mind that you can also use a 5-candle swing pattern, which can make the swing points stronger and more reliable. But to understand why these swing points matter, you also need to understand the psychology behind them. If someone wanted to buy this pair here, they would probably place their stop loss below this area to protect the position from normal market fluctuations. Similarly, if someone wanted to sell here, their stop loss would most likely be placed above this candle. At the same time, breakout traders may open positions if these levels are broken. With this in mind, we know that buy-side liquidity rests above this high, while sell-side liquidity rests below this swing low. So how do we use this concept inside our trades? If our bias is bullish, the formation of swing lows before price taps into a demand area can be a strong confirmation that the bullish movement we are expecting may develop. This happens because the market has a chance to absorb the liquidity, or fuel, required for the next move. If price does not collect enough liquidity, it may move lower first to sweep more sell-side liquidity before continuing the bullish movement. The same concept applies in a bearish scenario. If our bias is bearish, the formation of swing highs on the way toward a supply zone can provide strong confirmation of a potential trading opportunity. This brings us to the next important liquidity type: equal highs and equal lows. As the name suggests, equal lows form when price creates lows around the same level. In the same way, equal highs form when price creates highs around the same level. So what does this tell us in terms of price action? Double bottoms and triple bottoms are common areas where traders look for opportunities, because many retail traders expect price to reject upward when it returns to that level again. Because of that, they enter long positions at these levels and place their stop losses below the structure. However, as we mentioned earlier, smart money often aims to trigger those stop losses before the real move begins. That is why it is important to wait for liquidity to be taken before entering the market. If a demand area exists below the equal lows, there is a strong possibility that price may break below the level, sweep the liquidity, and then push higher. This is one of the key trading patterns inside smart money concepts: waiting for price to take retail traders' stop losses, and then looking for an entry from the demand area. The same idea applies in a bearish market. When price taps into a resistance area, retail traders may enter short positions, expecting a rejection to the downside. Their stop losses are usually placed above the zone, creating a large pool of liquidity. If smart money wants to sell, they may push price above this resistance area first, taking the liquidity resting above it, and then drive price back down in the original bearish direction. As smart money traders, we look for entries only after those stop losses have been swept. Now let's look at a few real chart examples on the gold 30-minute chart. Here, we have a clear uptrend, and a recent support level has rejected price several times. When price approaches this level again, many traders will look to go long, expecting another rejection from the same area. At the same time, traders who entered long positions earlier may try to protect or support their existing positions. This creates an important liquidity level because stop losses begin to accumulate below the support. So where can we enter as smart money traders? If we look to the left side of the chart, we can identify a fair value gap, which acts as an extreme demand zone. This gives us a clear opportunity to place a buy limit order inside that zone, with the stop loss positioned below the demand area for protection. After sweeping the liquidity, price rejects the zone and pushes higher, exactly as expected. However, when you trade live markets, you will inevitably experience losing trades, missed entries, and setups that do not play out. That is why it is essential to follow your trading rules and risk management plan so you can take advantage of winning opportunities when they appear. Remember, trading is always about the future, and the future is naturally uncertain. On the Euro-Dollar 15-minute chart, we can see a strong uptrend, where the most recent impulsive move created equal lows. This level may act as support when price returns to the zone again. Below these equal lows, there is a significant amount of liquidity. If we look to the left, we can also identify fair value gaps, which can act as strong demand areas just below the liquidity zone. A strong trading setup would be to wait for price to break below the equal lows, take the liquidity, and then look for a long entry from the demand zone. You might ask, doesn't a break below this area indicate a change of character and a possible shift in market direction? Under normal conditions, yes, that would often be interpreted as a change of character, suggesting that the market is no longer bullish. However, in this specific scenario, The change of character becomes less reliable because of the liquidity context. Sometimes, market structure levels lose part of their importance when they are combined with liquidity concepts. In smart money trading, liquidity and market structure must be read together because they are deeply connected. Now let's talk about the next key liquidity zone, turning points. Turning points are areas on the chart where price changes direction after an extended trend. These levels are often seen by traders as overbought or oversold areas, which increases the chance of a reaction when price returns to them. They contain significant liquidity because they attract attention from both retail traders and institutional participants. The importance of turning points can be understood through three main elements. These elements are the accumulation of stop-loss orders, their psychological importance, and the tactics market makers may use to manipulate price around these levels. To use this concept effectively in your trading, begin by identifying major turning points on the chart. These are areas where price reversed sharply in the past, and they are likely to contain clusters of stop-loss orders or pending orders. Next, wait for a liquidity grab below the turning point. This often appears as a sharp spike beyond the turning point, where stop-loss orders are triggered, followed by a strong reversal. After identifying a possible trade, wait for confirmation after the liquidity sweep, such as a strong bullish momentum candle or a change of character in market structure. Then, enter the trade in the direction of the reversal. Place your stop-loss just beyond the liquidity sweep to protect the position from additional unexpected movement. For take-profit levels, use the next logical market objective. You can target the next important support or resistance level, or use Fibonacci retracement levels to add more precision to your exit plan. By following these steps, you can include turning points and their liquidity dynamics in your trading strategy in a more structured way. Daily high and daily low. Daily highs and daily lows are important liquidity levels on the chart. The daily high is the highest price reached during the trading day, while the daily low is the lowest price reached during that same period. These levels often attract strong attention from traders, with many placing stop-loss orders or pending orders around them, which makes these areas rich in liquidity. For traders who use smart money concepts, these levels can create strong opportunities. When price approaches the daily high, it may briefly move above it before reversing back down. This move can trigger stop losses from traders who were selling, while also activating buy orders from breakout traders. A similar situation can happen near the daily low, where stop losses from buying positions are triggered before price reverses. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.